Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided is general in nature and does not take into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider whether it is appropriate for your circumstances and seek professional advice from a licensed financial advisor. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. It is based on our understanding of regulations and laws as at the publication date. As these are subject to change, you should talk to a professional advisor for the most up-to-date information. Any examples or illustrations provided are for illustrative purposes only and are not a guarantee of future performance. We do not accept any liability for any loss or damage incurred by reliance on the information provided. Any opinions expressed are subject to change without notice. Past performance is not indicative of future results, and all investments carry risks. Neither the host, guests, nor any affiliated entities accept liability for any loss or damage arising from reliance on the information provided. By listening to this podcast and viewing this presentation, you acknowledge and agree to these terms.
Good morning, team. How are you all? Sorry for a slight delay. I was actually getting everything set up for the first time all by myself. Typically, I've got the media team in the background doing it all, but finally got there. Found what I needed to do in order to get everything up and running. So, welcome everyone. It's been a few weeks, and I'm back. Financial Planning Thursdays. So I hope everyone's been well. And look, the scenery is a little bit different. Currently at a conference in Tasmania. Awesome place. So if you haven't been here for a while, come down, but make sure you bring your jacket with you because it is much, much cooler here than it is even in Melbourne. So yeah. Anyway, hopefully everything is working, and I'll see if I can get any chat going or anything like that. So yeah, bear with me, guys. So if I don't respond to you or your message on here, oh Pat, no, I can see you. Good morning, Pat. Good to see you. Yes, everything is looking like it's tracking along perfectly. Great. So let me dive into today's topic. So I actually wanted to chat to you guys about different types of super funds. But before I do that, I just want to quickly run you through an update from the US. So it came out this morning. So the US have cut their rates by 0.25%. So Jerome Powell came out earlier this morning for us and sort of afternoon for them, and made that announcement. So we saw the S&P close out in the red, right? So I think typically that tends to happen. There's not a lot of clarity around what the next steps may look like. So the information will get processed over the next several days, and hopefully that would turn around the performance. So because typically, if you think about it, when the interest rates go down, the financing becomes a little bit easier, and the interest on the short-term fixed interest falls. So therefore, people tend to go into other assets that can provide them with better income. So, however, right, one of the key things to be looking at is not just the short-term fixed interest rates, but also long-term, right? So the long-term rates are still sitting at around 4.6%. Which basically becomes the risk-free baseline for your investment. By the way, sorry if the video is a little bit choppy. I am streaming through my phone, so hopefully that improves. So key things behind this decision, right? The unemployment rate has gone up in the US, which is an issue. Hence, the rates came down. There's a bit of a balancing act there. So, as you know, when you reduce the rates, you do create a bit of an inflationary exercise. But to capture the unemployment rate or increase in unemployment rate, they're looking to reduce the rates. Hopefully that gives a bit of a boost for employees to go out and employ some more people. They've also indicated that they might do another couple of cuts before the end of the year, so up to about another sort of 0.5%. So it's, like I said, it's a bit of a balancing act for them at the moment. Just looking at my notes here, the rate cut will likely, create a bit of an inflationary pressure that they're trying to keep under control as well. So again, the mandate between 2 and 3%. But if they don't do further cuts, then the unemployment rate might get away from them as well, which will create other issues. But look, in essence, they cut the rates, which is something that they've been looking and talking about for about 12 months now. Some may say that it's coming a little bit too late. Some are saying that it might be just the start of another rate cut cycle. So anyway, hopefully we'll know a little bit more throughout the day and over the next week. And when I come back to you guys next Thursday, hopefully I'll have more details for you then. But over to the actual topic for today, which I wanted to run past you, which basically stemmed from my conversations over the last 6 months with new clients that I'm onboarding. And one of the themes that I've sort of come across is that the superannuation by itself sounds simple, right? It's money that you putting away for your retirement, essentially. But when we talk about super, I think a lot of people tend to misinterpret what it means. So there's a couple of different layers to it. So up until now, over the last how many episodes, we've been all talking about investments, right? So the investments that you have within the super fund. But before that, right, you actually need to select the super fund that will carry those investments. So basically the vehicle that you will be investing through. And whilst it sounds relatively simple, there's actually a number of super funds available to you. And, you'll fit different sort of strategy along your journey. So to make it nice and simple, I've actually broken them down. So the most simplest super fund that we all know about and heard about, that's called industry super fund. right? So, as it states, it was typically usually set up by industries back in the days, and they hold the majority of the superannuation funds. Super cheap, heaps of members. Industry super funds like Australian Super, Host Plus. Those are the names that you probably heard of, and they typically set up. You go to your employer, and they give you a super fund, something along that channel. So super easy. It is limited in terms of investments. So up until maybe recently, they've typically had about 12 different types of investments, sort of bundled up into what they call balanced growth. Maybe I think they've renamed it now to My Super, and now they're also offering a little bit of equities trading in there as well. But typically, it's one of those funds that you go into it, you just put your money into it, and then over time you don't really do anything with it until you sort of hit retirement, right? So low cost, minimum investment options, and you got a trustee there that is looking after it. So if that's not something that you want, and you want to take a little bit more action and be a little bit more active in this space, well, then you will go to what is called a retail super fund. So a retail super fund, something as an example, like a Macquarie or a Hub24 or Netwealth, right? So all of these guys are listed on ASX, but ultimately they provide a super fund. And the main difference there is that they just got a much broader investment menu. So now you can invest into things like the Vanguards, you can invest into active managers that may potentially only deal with a certain type of investment type. It could be, let's just say, mid-cap Australian equities only. So you can go out and select those investments. And that's typically, as a retail client, you don't really, get exposure to that. So this is where we come in, and we kind of help you out to design a portfolio on the back of that. So it does come at a higher cost, essentially, because there's higher menu, which means that more options. So the trustee of that super fund has to sort of account for that as well. What's next? The next one is the self-managed super fund. So this is where you say, you know what? I don't want industry fund. I don't want retail. I want to do my own stuff. I want to manage super by myself. And I'm going to be the trustee. So the difference here is that, and this is why we always say SMSF is really a complex structure, because you become the trustee. And what does the trustee do? In very simple terms, they look after compliance, they look after tax returns, they're making sure that everything is invested within the guidelines. So, and it gives you, and in terms of the investments, it's unlimited, right? As long as the trustee of the super fund, which is the rule book essentially, allows you to invest into it, then you're good. If you want to go out and buy a classic vehicle, then you can. You can't do that with the other two options, right? So, typically, clients with property, that's probably one of the options to be able to purchase a property, commercial or resi, using a self-managed super fund. You would be sort of looking at that at SMSF type of holding structure, right? So I typically say, you need a significant amount of balance to even think about it, just because it's expensive, because all of these things that you pay for in terms of administration with industry and retail, you have to now pay somebody else to be able to do that, unless you want to do it yourself, which obviously requires a level of understanding around accounting and things of that nature. So those are the three that are probably the most common ones. There are a couple of other ones that you probably may not come across that often. One of them is a corporate super fund, right? So these are typically offered to bigger corporations like, let's just say Commonwealth Bank, for example, or BHP. So what they would do is they would set up a super fund that would be basically, they'll call it corporate because it's to do with that business, and they would then get all their employees into that, and they might offer something extra above and beyond what maybe a retail super fund might have. So they might offer, what I've seen in the past, an insurance for their members. So it might be a reduced cost, or they might pay for some of it depending on your work within the organization. And typically, they might be able to get better costing structure around the investments, right? So they typically would have an external investor coming in and managing that for you. So, it depends, again, on every single person, whether that's worthwhile or not. But, that's something that, you may or may not be seeing or have come across in the past. Some lucky customers or clients have what they call a defined benefit, right? It's no longer available across broader sort of pool of clients, but some do have defined benefits, which are sort of old schemes where, in simple terms, you put away money, and then in return, when you retire, they can give you either a lump sum in return, or they can give you a lifetime pension. So, or a combination of both as well, right? So not applicable to a lot of people because this scheme kind of finished up a little while ago. But there are a couple of lucky people that still have that going. So, yeah. So ultimately, summarizing everything, you do have different options in terms of how you can carry your investments, because ultimately the super fund by itself, like, let's just say if I use names like Australian Super, Macquarie, Netwealth, Hub24, let's just say BHP, Corporate Super Fund, these are just names of your vehicle. It's like a Volvo, Mercedes, and the Ferrari, right? So they're all names of those vehicles, but the actual engines are much different with the engine, which will be your investment. So, you can't put in a Ferrari engine into, what car did I say initially? I don't know, a Toyota, right? So you can't do that. So therefore, you require the right vehicle for your investments. So if those investments are not available through industry or retail, then you have to go to the SMSF, right? SMSF can still hold the same investments as the other two, but the other two cannot hold all of the investments that the SMSF can. So make sure that when you're having a chat to your accountant, to your financial advisor, that when you say, look, my super fund, Australian Super, delivered 10% return. Well, it's not actually Australian Super; it's the underlying investment within that within Australian Super. Australian Super is just a platform that allows you to hold these investments, right? So. Hopefully that gives you a little bit of clarity about your different options that you might come across, and give you a little bit more understanding about what is that drives the return. It's not the name of the super fund, it's the underlying investment within the super fund. So, yeah, that's it, guys. I hope that this was insightful, and you guys got some value out of it. I'm going to try and close next Thursday. Hopefully, my connection will improve, and I will see, because I know where to navigate to get everything sorted. But until next week, enjoy your weekend, and catch you all then. See you later. Bye.
Folks, make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6 Star team here at positivementor.com.au.